Right now in Shanghai, a warehouse manager is staring at shelves that once held 5,000 tons of silver. He's got 715 tons left. That's an 86% collapse. And 50 industrial buyers are demanding delivery this month, offering premium prices just to secure supply. Something unprecedented is happening in the global silver market right now. China just shipped 660 tons of silver in a single month. That's the highest volume ever recorded. And it's not going to Chinese factories. It's going straight to London. Why would China drain their stockpiles and ship precious metal halfway around the world? Because London's vaults are running dangerously low. The global physical silver market is teetering on the edge of complete breakdown, and most people have no idea what's coming. This isn't the first time we've seen this pattern. It's happened 3 times in the last 100 years, and every single time, silver didn't just increase. It absolutely exploded. We're talking gains of 2 times, 5 times, even 37 times in documented cases. Think of the silver market like a game of musical chairs. Stage 1, everyone's dancing. Music is playing. Everything looks completely normal. Stage 2, someone quietly starts removing chairs while the music continues. Nobody notices because they're still dancing to the rhythm. Stage 3, the music suddenly stops. Panic sets in. Everyone realizes simultaneously that there aren't enough chairs for all the players. Stage 4, it becomes a desperate fight for the last remaining seats. People will do whatever it takes to secure their position. Market analysts believe we just entered stage 3. The music stopped, the scramble has begun, and there simply aren't enough physical chairs to go around. Let me walk you through the exact moments in history when everything changed. April 5, 1933. Franklin Roosevelt signs Executive Order 6102. This wasn't a polite suggestion from the government, it was an absolute mandate. Every American citizen had to surrender their gold to the government at a fixed price of $20.67 per ounce. You didn't get a choice in the matter. You either complied with the order or faced serious legal consequences. But here's what most history books conveniently leave out. The government didn't stop their confiscation program with gold. They came for silver next through legislative action. The Silver Purchase Act of 1934 followed immediately. The Treasury started buying silver at artificially inflated prices. Why would they do this? Because controlling the metal meant controlling the entire money supply. It was about power, not economics or fairness to citizens. What happened to silver prices after the government intervention? Silver exploded from around 28 cents per ounce to approximately 81 cents by 1935. It nearly tripled in just 24 months. Not because silver became more useful overnight. Physical scarcity drove the price. Fast forward to August 15, 1971, Sunday night. President Nixon interrupted regular television programming across America with an emergency address. He announced the United States would no longer convert dollars to gold. The Bretton Woods system died in one sentence. Why did Nixon make this shocking announcement? Foreign governments had been systematically draining Fort Knox for years. They'd been exchanging paper dollars for real physical gold. According to official records, U.S. gold reserves dropped from 20,000 tons to just 8,000 tons. The bleeding had to stop. What happened after Nixon closed the gold window? Gold absolutely exploded from $35 to $850 by 1980. Silver followed the same trajectory. It went from $1.29 in 1965 to $6.70 by 1974. But silver wasn't done climbing yet. By January 1980, silver hit $48 per ounce. Think about that for a moment. Silver multiplied 37 times in just 15 years. Some analysts blame the Hunt brothers for manipulating that spike, but they didn't create the trend. The Hunt brothers simply rode a wave that was already building from systemic factors. The monetary system had fundamentally changed. Real assets were repricing against increasingly debased paper currency. Silver was responding to forces far bigger than any individual players in the market. September 15, 2008. Lehman Brothers collapsed overnight. The fourth largest investment bank in America disappeared from existence. Within weeks, the entire global financial system was on life support. Banks stopped trusting each other. Credit markets froze solid. Panic spread worldwide. Governments responded with unprecedented money printing on a scale never seen before. The Federal Reserve's balance sheet exploded from $800 billion in 2007 to over $4 trillion by 2015. Investors noticed. They started panic buying physical precious metals. Coin dealers across America ran completely out of inventory. National mints struggled desperately to keep up with surging demand. Silver prices responded accordingly. By April 2011, silver hit $49.83 per ounce, from under $9 to nearly $50 in 3 years. Silver quintupled in just 3 years during that crisis. 3 times in history, 3 different crises, similar patterns unfolding, similar explosive outcomes. But here's what should make you pay extremely close attention right now. Notice how each cycle takes progressively less time to complete. 1933 to 1935 took 2 full years. 1971 to 1980 took 9 years. 2008 to 2011 took only 3 years. The cycles are accelerating, and the current cycle reportedly started in 2020 with massive money printing. We're 5 years into this cycle right now. Many market analysts believe we just entered the critical stage 3 phase. Let me show you exactly what's unfolding in real time. Because this isn't speculation or theory. This is based on verifiable data from exchanges and government agencies. March 2020, the pandemic hits global markets. Governments around the world reportedly printed $20 trillion in just 18 months. But something else started happening quietly in the background. Industrial demand for silver began surging to unprecedented levels that nobody anticipated. Solar panels require massive amounts of silver. Each gigawatt of solar capacity reportedly needs roughly 1 million ounces of silver. China alone installed over 250 gigawatts in 2024. That's potentially 250 million ounces consumed just for Chinese solar installations. Electric vehicles are devouring silver supplies. Every single EV uses approximately 1 to 2 ounces of silver in its electrical systems. Global EV production is ramping up exponentially. 5G infrastructure, artificial intelligence data centers, new technology that didn't even exist 10 years ago. All of this cutting-edge technology requires silver. According to industry reports from the Silver Institute, global solar demand alone hit 680 million ounces in 2024. But here's the massive problem that's creating this crisis. Mining can't keep up with demand. Total silver mining production reached approximately 813 million ounces last year. Sounds like a lot, right? But total industrial demand exceeded 1 billion ounces. We're running a deficit of approximately 95 million ounces this year alone, and this is the 5th consecutive year of deficit. The cumulative shortage from 2021 to 2025 totals around 820 million ounces. That's an entire year of global mining production just gone, vanished from available supplies, yet prices stayed relatively suppressed for years. How is that even possible with shortages? The answer lies in the paper market manipulation. For every single physical ounce of silver that actually exists, there are reportedly between 100 and 400 paper claims on commodity exchanges. Banks hold massive short positions, selling contracts promising to deliver silver they don't actually have. This paper game artificially suppresses prices by flooding the market with fake supply. But something fundamental shifted recently in the market dynamics. China, which had been steadily accumulating silver for years, suddenly flipped their strategy overnight. They transformed from net importer to massive exporter almost instantly. 660 tons shipped in 1 month. That's the highest volume ever recorded in market history. But here's what really matters and what most analysts are missing. Those 660 tons didn't magically appear because China suddenly discovered excess supply sitting around. Market analysts believe those tons appeared because London was in full-blown crisis mode. The physical silver market was breaking down. London's vaults were running dangerously dry. How do we know this with certainty? Look at what happened to the lease rates in the market. When lease rates explode, it typically signals one critical thing. Nobody wants to lend their physical metal anymore. Why? Because they're genuinely concerned they won't get it back. Trust in the system evaporates. Lease rates in London reportedly spiked from under 1% to 39% annualized. That's believed to be the highest lease rate ever recorded in silver market history. But the crisis signals don't stop there. Traders started doing something absolutely unprecedented. They began air freighting silver across oceans. Let me emphasize how insane that decision is for a commodity. Silver is a heavy metal that normally ships by ocean freight because shipping costs significantly impact profit margins. When you're air freighting silver, paying premium rates for speed, it suggests extremely urgent market conditions. The kind where buyers literally cannot wait 2 weeks for normal delivery schedules. In late 2025, the United States government made a critical designation. They declared silver a strategic critical mineral for national security. This isn't merely symbolic political posturing. Section 232 tariff investigations followed immediately. Potential import duties are now being actively considered. Current estimates for potential tariffs range from 15 to 50% on imported silver. And here's the crushing reality. The United States reportedly imports 64% of all the silver it consumes domestically. What happens when you threaten tariffs on critical imported materials? Precautionary panic buying begins. Approximately 75 million ounces have reportedly flowed into United States vaults since October alone. Industrial users, investors, institutions, everyone's scrambling simultaneously. Because if tariffs actually hit, imported silver could become 50% more expensive, literally overnight. Nobody wants to be caught without supply. Meanwhile, back in China, the vault situation continues deteriorating rapidly. Shanghai Futures Exchange currently holds around 715 tons. That's down approximately 86% from pandemic peaks of over 5,000 tons. The drawdown is absolutely staggering in its magnitude and speed. Shanghai Gold Exchange inventory sits at roughly 531,000 kilograms. That's reportedly the lowest level recorded since 2015. And here's the market signal that many experienced analysts find most significant. Chinese spot prices are now trading at a clear premium over Western prices. Approximately $60.30 in Shanghai versus $57.80 in New York. That premium typically means one critical thing is happening. The paper game is finally breaking down. Physical metal is proving more valuable than paper contracts. Reality is reasserting itself over financial engineering. When the physical market and paper market diverge like this, experienced market observers suggest it means only one thing. There simply isn't enough real silver available to satisfy actual demand. The leverage in the system is collapsing. We're in stage 3 right now. The music stopped playing. The scramble for physical chairs has officially begun. Now some analysts will confidently tell you that China's going to release massive hidden reserves any day now. They'll claim those reserves will stabilize the market, everything will calm down, prices will retreat. Maybe that's true, but I have questions. If China truly possessed massive hidden reserves somewhere, why would they deliberately drain their public stockpiles by 86%? Why export 660 tons in 1 month, when they could potentially wait and sell at even higher prices later? The behavior doesn't match that narrative at all. Either the hidden reserves don't actually exist, or they're being held for strategic military reasons that override profit considerations. Either scenario suggests the same conclusion. The physical shortage in global markets is absolutely real. This is where the situation gets genuinely interesting. We're not at stage 4 yet, but many critical pieces appear to be falling into place simultaneously. Right now, there are reportedly over 800 million ounces of silver in open paper contracts on the COMEX exchange. Physical inventory actually available for delivery sits at approximately 40 million ounces. That's a 20-to-1 leverage ratio. If even 10% of contract holders suddenly demand physical delivery instead of cash settlement, some analysts believe the system could face catastrophic challenges. The exchange might have to settle contracts in cash, and when that happens, trust in the entire paper market could evaporate overnight. Industrial users would likely panic immediately. Solar manufacturers need silver now for current production, not next quarter, not next year, right now. Production lines shut down completely without it. They'll pay absolutely whatever premiums necessary to secure guaranteed supplies. Price becomes irrelevant when supply is existential. Then governments might step into the chaos. When silver hits $75 or $100, politicians will launch investigations into alleged market manipulation. They might impose export restrictions. Each action makes the shortage exponentially worse. Why? Because it signals to everyone paying attention that this crisis is real. Hit that subscribe button right now. What's potentially coming next could be one of the most significant wealth events of this entire decade. I'm going to break down every stage as it unfolds, based on historical patterns and current market conditions. You need this information. Here's where leading analysts believe silver prices are headed over the next 18 months. Primary scenario suggests $90 to $100 per ounce by mid-2026. That would represent approximately a 64% gain from current price levels around $58. This base case assumes continued physical shortages in global markets, potential United States implementation of tariffs around 25% on imported silver, accelerated industrial panic buying as supplies become increasingly scarce, Analysts like Larry Lepard are reportedly targeting $75 by mid-year, 80 to 90 by year-end. Felipe Villegas at BNP Paribas reportedly told CNBC he sees silver breaking above $100 by the end of 2026. But understand something crucial. That's what many consider the conservative base case scenario. There's a real possibility we could see something far more dramatic unfold. If the COMEX exchange faces actual delivery defaults, if governments impose strict export bans, if investors worldwide flood into physical metal all at once, some projections suggest we could see $120 to $170 by summer 2026. That would represent a 150% gain. Sound extreme or unrealistic? Let me give you historical context. In 1979 to 1980, silver exploded from around $6 to $48 in just 14 months. That's approximately a 700% gain in barely over 1 year. Unprecedented but documented. In 2010 to 2011, silver rocketed from roughly $17 to $49 in 10 months, around 188% gain. These aren't theoretical projections, these are actual historical events that really happened. And here's the fascinating context most people miss completely. When you adjust the 1980 peak of approximately $48 for inflation, that equals around $178 in today's money. We're at $58 right now. We haven't even reached the inflation-adjusted all-time high yet. Silver at $60 isn't expensive. It could be artificially suppressed for decades by paper market manipulation. So how should you think about positioning yourself for what's coming? You don't need to predict the future perfectly. You need to understand the risks and act accordingly, based on your personal situation and risk tolerance. If you believe China's vaults are truly depleted, and this historical pattern is completing right now, consider focusing on physical silver, coins, bars, allocated storage, where you actually own specific metal. Some experts strongly suggest avoiding paper ETFs that may not have the backing they claim to investors. Consider securing your position before potential tariffs hit and premiums spike even higher than current levels. Time could be your enemy here. If you think the shortage is real, but maybe not as severe as some data suggests, consider taking a moderate diversified position across precious metals. Set price alerts for key psychological levels. $65, $75, $90. Reassess your position as new data comes in. Stay flexible. If you're genuinely skeptical about this entire thesis, that's completely fine. But at minimum, watch the critical signals closely as they develop. Monitor lease rates carefully, track COMEX inventories, watch government actions, follow Chinese export data. The pattern doesn't require you to believe in advance. It just requires you to pay attention when the evidence becomes clearer. React when the signals confirm the thesis. Now let's be completely honest about what could go wrong with this analysis. China could release massive off-exchange reserves that we don't currently know about. Demand could collapse if prices hit $100, and industrial users find viable substitutes. These are real risks worth considering. The economy could crash into severe deflation, and deflationary pressure could dominate temporarily. Government intervention and price suppression could continue far longer than anyone expects. Central banks could coordinate to crush the silver price. Those scenarios are absolutely possible. I'm not dismissing them. But here's my perspective, based on studying market history. Physical shortages don't care about paper prices in the long run. If there's genuinely no metal available to deliver, the paper game eventually ends. Reality wins. And if the economy crashes severely, governments will likely print even more money. Crisis leads to money printing. Money printing leads to hard asset rallies. That appears to be the consistent historical pattern across multiple cycles. As of early December 2025, silver recently set a new all-time high above $59 per ounce. It's currently consolidating. The metal is trading around $58, holding near these record levels. But that's not the key story in my view. The key story is what's happening beneath the surface in physical markets. China's vaults reportedly depleting at unprecedented rates. London's lease rates at highest levels ever recorded. United States government just declared silver a critical mineral for national security. Approximately 820 million ounces of cumulative deficit over 5 consecutive years. 5th straight year of shortages. Traders air freighting a metal that should ship by boat. Paper leverage at roughly 20 to 1 on COMEX. Those aren't random isolated facts. Many experienced analysts believe those are clear warning signs that appear right before stage 4, right before prices move in ways most people won't believe until it's already too late. Remember that musical chairs analogy from earlier in this analysis. We're past the part where the music stops playing. We're potentially deep into the scramble phase now. People are realizing there may not be enough chairs, and the last person standing might pay absolutely whatever it takes to secure a guaranteed seat. The desperation phase could be approaching. You asked which historical example this current situation mirrors most closely. Here's my honest answer. All three previous cycles simultaneously. We have clear elements of 1933's direct government intervention. We have aspects of 1971's fundamental monetary system shifts. We have characteristics of 2008's financial panic. All three historical patterns potentially converging simultaneously in one massive cycle. That's why this cycle could potentially be bigger than anything we've ever seen before in silver markets. The question isn't necessarily what happens next. The pattern has already shown us 3 times what comes next. The real question is simple. Will you be properly positioned if this pattern completes as history suggests? Will you take action before the crowd realizes what's happening? Or will you wait until it's already too late to get favorable pricing? Let me break down the supply situation even further. Global mining production has essentially flatlined for years. Major silver mines take 7 to 10 years to develop from discovery to production. There's no quick supply response possible. Recycling can't fill the gap, because most industrial silver is consumed in tiny quantities across millions of products. Meanwhile, demand continues accelerating from multiple directions simultaneously. Solar installations are projected to double again by 2030. Electric vehicle production is ramping exponentially. Data centers for artificial intelligence are being built at unprecedented scale. Every trend points toward dramatically higher silver consumption ahead. The math simply doesn't work. Supply is relatively fixed. Demand is exploding. Inventories are depleting. Something has to give. The only variable that can adjust quickly enough is price. Price must rise dramatically to either ration demand or incentivize new supply years from now. Let's talk about the COMEX situation specifically, because it's critical to understanding what could trigger stage 4. The exchange has successfully managed paper leverage for decades. They've convinced the market that paper claims are equivalent to physical metal. That illusion is now cracking. When lease rates hit 39% annualized, it signals that physical metal holders don't trust the system anymore. They're not willing to lend at normal rates. They want massive premiums because they're genuinely worried about getting their metal back. That's a clear red flag. If the COMEX has to start settling contracts in cash instead of physical delivery, it destroys the entire premise of the futures market. The exchange exists to facilitate physical delivery. Once cash settlement becomes the norm, the paper price becomes meaningless. Physical and paper markets completely decouple. We're already seeing signs of this decoupling. Shanghai trading at a premium to New York. Physical coins and bars trading at premiums to spot price. Delivery delays stretching longer. These are symptoms of a system under extreme stress approaching its breaking point. The United States critical mineral designation changes everything strategically. It's not just about tariffs. It signals that the government views silver as essential to national security. That means silver gets treated differently during crises. Export controls become possible. Domestic production gets subsidized and protected. When governments start treating a commodity as strategic, prices typically explode. Why? Because government involvement signals scarcity and importance. Markets respond by bidding up prices aggressively. We saw this with rare earth elements. We're seeing it now with lithium. Silver is next in line. The tariff estimates of 15 to 50% aren't just theoretical. They're being actively discussed in Washington right now. If implemented, they would immediately increase the cost of imported silver. Industrial users would rush to secure supplies before tariffs hit. That rush itself creates a self-fulfilling shortage. 75 million ounces flowing into U.S. vaults since October represents about 9% of annual global mining production. That's a massive amount, moving in just 2 months. If this pace continues, it would drain over 400 million ounces annually. That's half of total global mining production. China's behavior remains the biggest mystery and potential catalyst. Why drain stockpiles so aggressively? 3 possibilities exist. First, they genuinely need cash and are selling assets. Second, they're preparing for something and want liquid funds. Third, they know something about global supply that we don't. None of those scenarios are bullish for silver availability. If China needs cash, they're under financial stress. If they're preparing for something, uncertainty increases. If they know supply is tighter than reported, that's the most bullish scenario possible. Either way, their actions suggest urgency. The 660-ton monthly shipment to London wasn't a one-time event. Reports suggest similar shipments continued in subsequent months. China is systematically draining their stockpiles and sending metal west. This is the opposite of what they normally do during commodity bull markets. Typically, China accumulates during price weakness and releases during strength. Right now, they're releasing during strength. That suggests either desperate need for liquidity or strategic repositioning. Neither explanation suggests abundant silver supplies globally. The behavior indicates scarcity, not abundance. Let's address the Hunt brothers comparison directly because skeptics always bring it up. Yes, the Hunt brothers tried cornering the silver market in 1980. Yes, they failed spectacularly and went bankrupt. But they didn't create the bull market. They rode a wave created by monetary instability. Silver was already rising before the Hunts got involved. It continued rising after they were forced out. The fundamental drivers were monetary debasement and inflation. The Hunts simply accelerated a move that was already happening. The lesson isn't that silver manipulation fails, it's that fundamentals ultimately win. Current fundamentals are arguably stronger than any previous cycle. The 1933 cycle was government intervention driven. The 1971 cycle was monetary system change. The 2008 cycle was financial crisis response. Today we have all three factors, plus structural industrial demand, that didn't exist before. Solar panels didn't exist in 1980. Electric vehicles were science fiction. 5G networks weren't imaginable. Artificial intelligence wasn't real. All of these technologies are now massive consumers of silver, with no viable substitutes at current price levels. This adds a completely new dimension to silver demand. The industrial demand floor means silver can't collapse like it did in previous cycles. In 1980, when investment demand evaporated, silver crashed because industrial demand was small. Today, even if all investment demand disappeared overnight, industrial consumption would continue growing. That provides downside support previous cycles lacked. This creates an asymmetric opportunity. Downside is limited by growing industrial demand. Upside is unlimited if investment demand returns or shortages worsen. Risk-reward favors the upside dramatically. You risk $58 to potentially make 100 plus. That's compelling math for any investment thesis. The inflation-adjusted 1980 high of $178 provides a realistic upside target. It's not pulled from thin air. It's based on actual historical precedent adjusted for currency debasement since then. If silver simply matched its previous real peak, we're looking at 3 times current levels. But remember, previous peaks happened without the industrial demand drivers we have today. Previous peaks happened with much lower government debt levels. Previous peaks happened with much smaller global money supplies. Every factor suggests this cycle could exceed previous highs in both nominal and real terms. The warning signs are flashing everywhere for those paying attention. Record lease rates, depleting inventories, air freight shipments, government intervention, paper market stress, Chinese stockpile collapse. Each signal independently would be noteworthy. All of them simultaneously is screaming that something major is developing. Stage 4 doesn't announce itself with sirens. It arrives suddenly when the last bit of available physical supply gets claimed. One day there's silver available at a price. The next day there isn't at any price. The transition can happen faster than anyone expects. This is why positioning before the crowd matters. Once stage 4 begins, premiums explode, delivery times extend indefinitely, dealers run out of inventory. You can't buy what doesn't exist. The time to act is before scarcity becomes obvious to everyone. If you found this analysis valuable, drop a comment right now. Tell me, do you own physical silver, paper silver, or nothing at all? I want to see where everyone stands. And if you know someone who needs this information, share it with them. What's potentially coming could separate those who prepared from those who waited.